So I've talked all week about index funds. I've talked about where they came from. I've talked about the good, the bad, the taxes, everything in between. But today I just want to narrow down and focus on performance and why we should invest in them based on historical performance. Yes, historical performance is not the only way that you should go about picking your investments. Like Jack Bogle said when we were talking Monday on some investing tips that he said, that's foolish. It's foolish to only invest in things that have gone up a lot over time because you'll likely get overvalued securities, mutual funds, ETFs that you end up buying, and those things will subsequently go down in value or not go up in value as much as the market as a whole. But nonetheless, right, I just want to stick to the two major indexes today. We'll talk about the Dow and the S&P and the returns that they have provided to investors over different time periods. Okay, so we'll start with over the last 100 years. We'll start with a really long time horizon. And this is just so you can know what is expected. What is an expected return on these types of index funds, on these major stock market indexes? What can I expect if I invest my money into an ETF or a mutual fund that tracks this particular index? Well, we'll start with the Dow Jones. The Dow Jones from April of 1921 to April of 2021, right? So a 100-year period. What we saw was a 6.269% return just on the price of the Dow Jones. Okay, now if you'll remember, our returns made up of two things: the change in price and the dividend reinvestment that goes back into that particular investment vehicle, right? And so the 6.269 does not take into account dividend reinvestment. If you take into account dividend reinvestment, you would have made 10.537% per year from 1921 all the way to 2021, which is an outstanding deal. That means on average, just about every 7 years, you would be doubling your money. So if you put in $10,000, 7 years later, you would have 20. 7 years later, you would have 40. 7 years later, you would have 80. 7 years later, 160. And then 7 years later, you would have $320,000. So just in a 35-year period of holding a $10,000 investment in the Dow Jones, on average, you would have $320,000, which is not too shabby. That just speaks to our ability to put away money early and let it grow and allow it to become a very substantial sum over time. And so that's the return that you could have expected in the last 100 years in the Dow Jones. Now, the last 100 years in the S&P 500 is very, very comparable to the last 100 years in the Dow Jones. Over the last 100 years, the S&P 500 has had a 6.588% return when it comes to just the price, when it comes to just the return of the index itself. But if you reinvested the dividends, you would have had a 10.75% return. So again, just about every 7 years, you would be able to double the amount of money that you had invested. And you could build really, really good amounts of wealth given these returns over time. These are returns that if you don't know financial markets too well, a 10% plus return is fantastic. If you can make 10% plus over a long period of time, then you are more than poised to build wealth in a very substantial way if you're just putting money away for yourself in a systematic fashion. Okay, so that is the last 100 years. Well, then what about, let's say, the last 50 years? The last 50 years, let's see how much that deviates from the last 100. So we would go back to 1971 on the Dow, and we say, okay, from 1971 to 2021, that 50-year period, what was the return? Well, the annualized return when it just came to price is actually higher. So now we have a 7.427% return annually. But the dividend reinvested return, it is even higher than that. And it is 11.008% annually. So you could have made more in the last 50 years than you made in the last century as a total. Okay. Now, obviously, if you take the last century into account, you're also taking into account the Great Depression, right, which was good for nobody's stock portfolio. So obviously having these returns tick up a bit is no surprise. But then what about the S&P 500? The S&P 500, if you go from 1971 to 2021, right, it actually underperforms the Dow Jones, which is a little bit surprising. And the reason that it's a little bit surprising is because the Dow is known to be these big, stable companies that, may pay dividends and, they're really long-standing companies that are probably not going to make the highest returns over time, whereas the S&P 500 is going to have companies that vary in size a little bit more, and it's going to hold likely what the Dow holds, but plus another 470 companies of varying size. But it still doesn't deviate way too much. And if you look just at the price return, you look just at the return of the index itself, it is actually higher than that of the Dow Jones over this time period, but the difference comes with the dividends. And this is where you can really see that dividends are so important. Okay, so the return just on the price itself was 7.635% annually, which is higher than the Dow Jones over the same period by about 0.2%. But the dividend reinvested return, right, is 10.713%, which lags the Dow Jones by about 0.3%. So the Dow Jones picked up a whole 0.5% just based on dividend reinvestment, which is a huge deal. So there's a 50-year, 100-year. Well, let's just look at the last 20. Okay, because the last 20 years, that is a time period that we've all been alive for. We've all seen occur. We've seen recessions. We've seen pandemics. We've seen all of these different things occur in the last 20 years. So let's just see what the returns have been in the last 20 years. Well, not in an extremely surprising fashion. The returns over the last 20 years have not been as high as the last 50 or the last 100 because we have had these major recessions. Right? Since 2001, we have had 3 major bear markets that have taken the market down quite a bit. Now, you still could have made really good returns. So with the Dow Jones, the return on just the price action is 6.115% annually. And then if you reinvest dividends, 8.674%. So you see that 8.674 as compared to like the 11% that you could have made over the last 50 years. That is quite the disparity. And then we move over to the S&P 500, and the S&P 500 over the last 20 years, we have seen a 6.352% return annually on the price, and then with dividends reinvested, 8.394% in the way of returns. So has still lagged the Dow in the last 20 years. Okay, so this is a little bit surprising because if you follow the market day to day or year by year, the S&P 500 has its way with the Dow in many years, but the stability of the Dow and the 3 major bear markets that we have seen have really pushed down the S&P 500 returns in a way that they have not pushed down the Dow returns. Okay, but regardless, the whole point here is that if you would invest in an index fund holding these types of companies, holding these particular indexes, right, then you're going to make a lot of money over time. Even if you make 8% annually, that's not the worst rate of return you could make, okay? And if that's what the market's offering, then nobody's killing the market by a large clip from year to year or over decades, right? So if you invest in the S&P 500 and it gives you 8.5% annually over a 40-year period, then, you know, that was probably the best return you were going to make over a 40-year period, or one of the best returns you could have made over a 40-year period. And the people who are outperforming the S&P would be very small in number, first of all, and then they wouldn't be beating the S&P by huge amounts. It'd be unlikely that you saw somebody making a 13% annualized return when you were only making 8.5% in the S&P. So this is just important to keep in mind. But this is my encouragement to you. Invest in index funds because the returns are good, right? 8.5% is not the best thing in the world, but relative to what these actively managed funds have done, and then you look long term and you can make 10, 11+% on the S&P or the Dow. I mean, just great ways to invest your money. And it's also, as we've talked about, great ways to keep it simple and keep it really tax efficient with our investing. So nonetheless, that is what the Dow and the S&P have done over these differing time periods.